Welcome to the Property Trio, the podcast for the sophisticated property buyer. I'm Cate Bakos and I'm joined by Dave Johnston and Mike Mortlock. How are you, fellas?
G'day. Hi, how you going?
I'm good.
Anyone?
You've got a spring in your step, Dave. This one's all about saving money on your home loan. I can sense the vibe. It's coming through the screen.
Oh, good to hear.
Well, today we're talking about something that is very real for a lot of mortgage holders right now: how to save money on your home loan. Since February this year, we've had 3 RBA rate increases, and together that's an extra 0.75% on interest rates, so 75 basis points. To give you an idea, if you have a mortgage of around $740,000, which is roughly around the size of the average new home loan, an extra 0.75% means about $5,550 more dollars in interest per year. That's around $462 more per month in interest. If your lending is $1 million, that same 0.75% increase is $7,500 more interest per year, or about $625 per month. So this isn't theoretical, it's very real. This is money coming straight out of household cash flow, and for a lot of borrowers, it is starting to bite. So if you want to refinance to improve cash flow, it's worth acting sooner rather than later. The window may be closing as your borrowing capacity reduces also, following the rate rises and the budget that has impacted negative gearing. So it's very timely. Today we're going to unpack where borrowers can save money, what people often get wrong when they try to do it on their own, and what a good strategic mortgage broker should be doing to help clients properly review their lending. At Property Planning Australia, Dave, you and the team are looking at this every single day for clients, so I'm looking forward to getting into the practical steps that our listeners can take.
Yeah, people are feeling the pinch at the moment, there's no doubt. And so I just thought it would be timely to have an episode on this topic for our listeners.
Yeah, very much so. Well, I'm going to kick off with the first question. Let's start with the borrower who's feeling the pressure right now. Their repayments have gone up, they're pretty frustrated, and they're thinking there must be a better deal out there. So what's the first thing they should do, Dave?
Yeah, look, the first thing they should do is get a home loan health check. And look, it's not about panicking and, refinancing across to the first shiny rate you see on the television or radio advertisement, or back in the day, if you heard John Simon's saying, "We'll save you." You need to do this properly. So that means reviewing what you've already got. So what we do is we start by looking at your current lending, your rate, the lender you're with, what sort of offers they've got available at the moment, and also your structure, whether there's any flaws in your current structure or strategy, and then look at what else is around, basically starting with your existing lender. So, really look, if you've got a good strategic mortgage broker, probably we aim to at least once a year review our existing clients' rates. That's a big function of one person's role, and compare it to the market. So we contact the lender on behalf of our clients and see if we can organise a better deal. Now, we probably have a success rate currently of around 20 to 30%. It depends on, the lender. It depends on what their offers are at the moment for their back book versus existing clients. It depends on the loan size. There's different factors. It depends on what the market's doing. People are, and most people know this nowadays, they're often sitting on a rate that was competitive a while ago and when they took out the loan, but that's become lazy over time. And that's how most sort of utility, if you like, providers pricing works. It whether it's your insurances, whether it's gas or energy or electricity, it's usually pretty competitive when you start, and then that falls away over time. So, and that's because most of these companies, they're competing for new customers, but they're not always generous with existing customers unless someone really puts pressure on them. Banks don't usually just tap you on the shoulder and say, "Good news, we'd like to reduce our profit margin." So you need someone to be watching out for you, or you need to be doing it yourself. And obviously, if you don't work with a broker and you just deal with a lender direct, they're never going to contact you and say, "We're going to reduce your rate for you." So a good broker will do this, and that's part of the ongoing value of the service a good strategic mortgage brokering firm will provide.
Yeah, nice. Mike, I got a question for you. You're sitting there quietly in the corner. How do you think about this, and how would you approach it yourself as someone with a mortgage?
Didn't know I was in the corner. It's
Naughty
revealed something
corner.
I didn't know about the show. Look, obviously Dave's the guru. You'd be mad to argue with any of his advice, but I think my approach is outsourcing it, right? Like I've spent decades of my life being good at one very, very narrow thing in life. And there's other people that do that in other parts of the economy and professional services, like Dave and like yourself. Like for me to go and race against Dave in the mortgage 100 meters would be foolish, as it would be to go up against you at auction or try and negotiate against you. So outsourcing it. I think there's a really good interplay when you can have an accountant and a mortgage broker working together along your strategy. And of course, strategy comes first. As I always say, like you've got to eat your veggies before you can have your dessert. And the veggies is the strategy, and the dessert is the hotspot or the property that we're purchasing. And one thing that I've learned is that loyalty counts for bugger all in the mortgage space. Like you would kind of think advertising, like if you swap over to this rate, like we're going to give you X, and there's all these people at home going, but wait, like I'm paying more than that. Like you would kind of think banks wouldn't advertise like that, but they do, and they don't really care. Right. So that's one big takeaway for me, is that, loyalty is dead in the mortgage space.
Well, yeah, you've opened a bit of a Pandora's box, and it's a nice segue into my next question for you. Let's talk about negotiating with the existing lender. A lot of borrowers don't do it at all, or they, ask the question without understanding what the right answer should look like. So, what are some tips that you've got for how borrowers could approach that conversation before you throw the baby out with the bathwater and start talking to other lenders?
Yeah, yeah, and look, I'm interested to be critiqued by Dave on this because this is his area of expertise. But like any good negotiation, you've got to have some sort of anchor and say, okay, well, I know for a fact that I can get this somewhere else, or I know value sits at this particular point in time. Without knowing that, you are kind of negotiating in the dark, so you don't want to go in blind. Of course, I mentioned before that loyalty is dead, and what I mean there is that, like, banks aren't going to come to you and go, oh, just to let you know, we're running this new thing for new people. So we want to sort of put you on that plan as well. It's just not going to happen. They're not calling you up and saying, like, we really want to get our profit margin down, so can you help us with that? So you don't want to be going into the car yard and saying, please be nice to me. You want to know these are all the comparable cars, or these are what on car sales or other dealerships are doing. So, of course, you might get a discount if you're just kind of saying, like, what can you do? But you won't actually know whether that's a good one. Of course, someone like Dave can help you to benchmark your loan against other lenders and send you off to do your very best. But you've got to understand what's there, a little bit like price matching. You've got to know, this is something that exists over there. I'm sure that you have KPIs to hold on to your book of loans. Like, if you can get anywhere near that, we can have a conversation. Otherwise, stick it up your jumper. How'd I go, Dave?
Pretty good, Mike, for someone who doesn't work in the mortgage industry. I think you've summed up really well.
Dave, a lot of borrowers will jump online and start comparing rates themselves. But where's the catch? What do people get wrong when they do that?
Yeah, look, one of the big mistakes they make is they think that the advertised rate is the actual rate you receive. So online, you might see a standard variable rate and then something like a package discount of, let's say, 0.7%. But generally speaking, that doesn't provide the full story. So depending on the size of your loan to value ratio, whether it's owner occupied or investment, whether you're paying principal and interest or interest only, the lender's current appetite for new business, all these things play into what discount you're going to get. And that's going to vary from lender to lender. As you saw there's about 6 different factors that could impact the level of discount that you're going to receive with any given lender. So it just isn't black and white like perhaps it was, when I first got in the mortgage industry 20 years ago. It was a lot simpler. There were definitely less moving pieces with how lenders looked at the different types of borrowers. So, this advertised rate of 0.7% that someone might see online somewhere or hear it over the radio, they might actually be able to qualify for a discount of 1%, 1.25, or even 1.5%, for example. But you don't really know that until you engage either your strategic mortgage broker or a lender. And that's just one example of why it can be messy when you try to do this on your own. The rate you see online is not always the rate you can get. And the lowest looking rate may not actually turn out to be the lowest if you're just comparing what's advertised. Because often once you get under the hood, there is actually more that you can squeeze out of the chamois, so to speak. So you're not just asking what's your rate, you're trying to work out what's your best rate based on your loan size, your loan to value ratio, your repayment type, and whether it's owner occupied or investor, or what that looks like across your entire portfolio.
Mike, when investors are looking at their cash flow, how important is this loan review piece?
Well, I talk about what I do with tax depreciation as being the second biggest deduction for property investors, and in first place is the loan. So it's absolutely massive. It's number one. So it's going to be the biggest expense attached to the property for most property investors. I mean, if you're paying cash or you've got a 20% LVR, that might be a little bit different, but most people don't have a loan like that on their investment property. So even a small rate difference can have a meaningful impact on cash flow. Now, the more that you're paying, the more that you can claim, and you can offset against that income in the financial year that you incurred the cost, or at least until 1 July 2027, thanks to the Labor Party. But of course, you can offset those gains against future, offset the losses against future gains. But that's a long waiting game until you sell. So it matters more than ever, I would argue. People get very focused on things like rent increases or tax deductions, but the biggest and quickest lever is going to be the debt itself. It all adds up, but the loan is that big ticket item. So if you're paying more than you should be on the loan, that can really eat away at your returns. So a proper review is not just a finance exercise, it's part of managing that investment or that portfolio.
And you can also, with the new, well, if it passes through, which it looks like it probably will, legislation, you can offset those cash flow losses once the rental property is positively geared, as well as against the sale.
Yes.
Yeah. Dave, let's say you've gone back to the existing lender, you've asked for a sharper rate, and they don't really come to the party. What's your next move?
Yeah, look, basically, as a borrower, you've got 2 options here. Firstly, we'll suggest to the client to actually call the lender themselves, and we provide them with a script. So we've done our best. We've tried to renegotiate on their behalf, and we've had no luck. And then we just let them know that. We give them that feedback, and then give them the opportunity to say, look, if you want to call the lender and try yourself, that might have a bigger impact than us trying to renegotiate your rate for you, because that hasn't succeeded at this point in time. And so give them the choice to do that. So, before making the call, you want to make sure you know what the other lenders are offering for your loan type, loan size, loan to value ratio, and repayment, as I've already mentioned. So you can have that conversation from a position of strength. Once you've got that information, the next step is to call the lender directly and say something along the lines of, I've reviewed my options. I can see there are sharper rates available elsewhere. And unless you can improve my rate, I'm going to move my lending to another bank. At that point, the bank will transfer you to their retention team. And that's important because the retention team is usually authorized to offer sharper discounts than the regular client facing staff or the pricing team where a mortgage brokerage would be trying to negotiate your rates for you. So that sort of is the team of last resort, if you like, because the job of the retention team is to make a last ditch effort to keep you as a customer. So this team will often be contacted when you're refinancing and you've already done all the loan documents, you've moved to another lender on the cusp of it, and that lender will get sent the discharge authority and then they'll contact you. So this, you can speak to them in advance. So if you want to go through all that process, that's something we will offer to our customers, and we've got a pretty cool script that we email over to them for them to use. So now they don't really know whether you can refinance immediately or if you're bluffing. So that's why, this can work. What they do know is that you're serious enough to have done your homework. If you've done your homework, that is. So at Property Planning Australia, we give our clients that script so they can manage the conversation with the lender's retention team. And we do that because unfortunately retention teams just won't deal with brokers. They'll only deal with the borrower themselves. So we just aren't able to have that conversation, but we can absolutely prepare people for it. The other option, if the existing lender won't play ball, is obviously to look at refinancing. And often people may just want to refinance anyway. Sometimes they won't want to make the call themselves. Sometimes they'll be over the existing lender. They'll have had a bad experience, felt like the service isn't what they would have liked, or they've been unsuccessful with the retention team, and so they'll be keen to refinance. And by this point, many people just don't want to give their existing lender another chance. So that they're basically the two directions we take with our clients if we aren't able to renegotiate the rate with the existing lender as the first option.
Yep. I love it. It is such a frustration when you're serious about getting a better rate and your lender's not coming to the party. I find it infuriating as well when you finally get that lovely call and all of the service and, all the trimmings. By then you're disenfranchised with them and you've probably already started going down that refinancing path, and it's just annoying that they let it get to that.
It is. It's very frustrating.
Yeah.
But that's the game. That is the game.
It is a game. It frustrates me that they look after new business better than looking after their current business. But let's talk about refinancing. Yeah. What does it look like if you do go down that refinancing path?
Yeah, so look, it's not just a matter of jumping at the lowest advertised rate, as we've already touched on. You do need to look at that full picture: rates, loan products, fees, the offset accounts available. Is there an offset account available? Is it a basic loan versus a package loan? What suits the client's broader requirements? And really then it's a matter of matching the client's strategy and structure to the lender who's going to price that loan competitively, factoring in their loan to value rate, repayment types, a mixture of whether it's investor, owner, occupier. All these things come into the picture as we've touched on. This is where refinancing can become difficult to assess on your own, particularly if you're just browsing advertised rates, because it doesn't really provide you with all of that nuance. And obviously, there's so many lenders out there. We've got access to over 50 different lenders. So they're, trying to do it yourself, as Mike sort of spoke to, it's a pretty sort of cumbersome process, and it can be lost in the weeds when you try to do that yourself. So, basically, if you're trying to compare multiple lenders yourself, that it can become time consuming very quickly.
Yeah, I certainly agree. And
I
to
go
put
so
it in
far as to
context,
say, like, don't. Sorry, Kate, but you just don't. Just like, don't
yeah.
do it yourself.
Well, if there's someone there to do it for you, and I guess that's a segue into the next question I've got for you, Dave, because at PPA you have access to more than how many lenders? 50?
Yeah.
That gives your clients a lot of choice, but it also means that there's a lot of complexity behind the scenes if you're making a firm recommendation off the back of 50 lenders. And it's not just 50 products, it's 50 lenders with multiple products. So, there's probably over 300 products, give or take. Every lender has different pricing, policies, servicing rules, credit appetite, and quirks. I remember as a broker, we'd workshop our scenarios, and you go, I've got an unemployed, or I've got someone earning offshore money, or I've got someone on a visa, or I've got someone who's only been at work for 2 weeks, but it's a related industry. Like, there's just so much complexity, and that's not introducing, third-party guarantors and all that kind of stuff.
I mean, that's a great example where, even if your strategy and your structure and your loan to value ratio and your mix of owner occupier versus investor debt all suits one lender, the policy may not suit based on your employment circumstances, self-employed, part-time, casual, new job. Yeah.
Yeah, I would come up with a bit more of an obscure solution. It might be second tier or a product that sounds a bit wacky, and then you might have a really favourable product. If you've got a client with a 30% deposit and 70% LVR, it opens some really good windows. They might have a really tricky property that they need to settle, and the valuation doesn't need to be done. They'll take contract price. I mean, there's reasons why a strategic mortgage broker might be recommending only one product. And that is the part that the people don't see, certainly not online either. The workshopping and the multiple minds having a look at a scenario sometimes is something that a borrower won't see. I remember being part of a really good team, and we'd sometimes all have to put our heads together and, understand all of these policies. And two lenders might look really similar on rate.
Yeah.
And one might be a complete waste of time for the scenario because it won't fit for that client, and the other might be a perfect fit. So part of the broker's job is knowing where to look, who to speak to, and who not to waste time with effectively.
Yeah.
And importantly, the broker does all that legwork for the client behind the scenes. I get frustrated when clients say, oh, they didn't present me with a portfolio of 5 options. If they're doing their job, they should have the option that they recommend. And if they're worried about any chance of risk with that lender, they might have a plan B up their sleeve.
Yeah, that's right. And we even have access to different tech that has fed in all the different lenders and their products and their policies. And then you can feed in, here's clients' information, incomes, profession, time in jobs, and it'll spit out some lender policies that might suit. But if the tech isn't bulletproof, it might provide a few different lenders and products and policies and options. And then, the broker, or in our case, often the credit analysts who support the brokers, then need to go and double check that the information provided by the tech is accurate, can be relied upon, because it's not always updated in a timely fashion. Some tech's better than other tech, etc. So, yeah, there's a fair bit. There's a fair bit that goes on behind the scenes to get to that point. And as Mike made the point, these are people like our credit analysts. All they do day in, day out is assess loans, lender policy, build serviceability calculations, make loan recommendations. That's all they do.
Yeah.
Every day of the week.
Parties, Dave.
I actually love the scenario part of that task. That's a really critical step, because the last thing you want to do is put the client with a lender that isn't the optimal option for them. And then the second last thing you want to do is get a hit on your credit file for an application that couldn't go through. And the thing that I always loved about working with a team, like a really experienced team, because I remember when I was the newbie and I had so much to learn from the seniors, they not only knew the policies and the exceptions to what a lot of mainstream lenders would say no to. They would find someone that could cater to these tricky, quirky scenarios. They also understood people at the bank, so they'd have like really good relationships with BDMs, or they might know of an assessor in a small team that they're likely to get each time. They also know how long each lender is taking for each of the important steps. So, you know, the certification process is where the loan documentation has been signed, and before the funding occurs on settlement day, it goes to certifications to make sure that everything that's been submitted and signed, you know, all the titles, everything is matching and ready to go. Well, if you need a really urgent settlement, there are some certifications teams that will turn it around outside of hours in a couple of hours. And then you've got assessment queues that can be like 2-3 weeks. If you've got a client that's bought on a 30-day settlement, you're not placing them with that lender unless you've got someone who can escalate it. So knowing the relationships that exist behind the scenes is something that no one talks about. And I think that's a huge part of mortgage broking.
It's a really good point. I mean, it does go beyond the things we're talking about here. I mean, there are, because of high volume that we do and some of our brokers do, we get direct access to some credit assessors with certain lenders where we can speak to them and we can agree, all things being equal, that in writing a loan will be approved once it's submitted, whereas most lenders don't want to do that. They have to wait until it's been lodged. You know, having the relationships is certainly, you know, makes a big difference. Knowing people in there who you can talk to, who will understand that, you know, you are, as a broker or a brokerage, a quality provider of loans, because one of the things they track is the percentage of lodgement to settlements. So, you know, there are brokers out there whose conversion is pretty low. You know, they don't lodge quality deals, not as many settle. So they don't get looked after as well by lenders because they're not as profitable. They're more time consuming for every settlement per lodgement. So look, there's a whole range of factors that come into play with this. And there's no doubt that the best credit analysts and strategic mortgage brokers are just at a higher level when it comes to knowing lender policy, niches and nuances, and where to place deals that are outside the square.
And, you know, back to those relationships, Dave, I've seen your team do it. Get a waiver on something, like have a credit assessor waive something through after putting up all of the circumstances and workshopping it. I remember doing it when I was a broker, and, you know, things that would automatically get a no from some banks. You've got some relationships where they'll hear you out. I remember presenting to a panel because I had this couple on the beaches in Sydney, and they had a really good wealth story, but they're high risk takers. And I needed to demonstrate to a lender why they should get away with a high LVR on stuff that might have looked risky to a lot of banks. And it was all about relationship. And I've seen your guys, it's not about bending the rules. It's about having that bank manager conversation that you used to do in the old days. You get the opportunity to do that when you have a trusted relationship with a lender. And I think it isn't talked about often enough, but there are deals that I've seen good brokers get across the line in that hour of need that an average broker was just getting rejection letters for.
Yeah. And that's basically, you know, to the letter of the law, to the letter of the policy, it should be declined. But a good broker, through relationship and skill, is able to get it approved. And that's a big part of the profession. Yeah.
We hear a lot, Dave, about these long lunches. And, you know, I know that you're not above going to lunch with some bankers. And, of course, you know, you cream as much off the top as you can if they're paying for the bill. But it's not just lobster and caviar. I assume that you are talking deals and they're interested in, you know, what's coming up with you, how competitive they are. Like, can you show us a little bit behind the curtain? Like, this isn't just a free lunch. There's a reason why that's happening, right?
It's a good question, Mike. It's probably, you have a combo of just regular conversation that you'd have with your friends and your mates, and but there certainly is an element of I might be talking about a loan that's in the system. I had a lunch recently with one of the major lenders and our state manager and BDM, and there was a problem deal with our top broker that had some issues because of a branch and the branch network, and we spent a fair bit of time talking through that, how to resolve it moving forward, the frustration of the client, what the client's perspective is um, in the situation, because often they don't, obviously they're not privy to everything that's going on behind the scenes. And so, yeah, you're talking about, spent a fair bit of time talking about the budget and, the changes and what's happening within inside of that major bank with their loan volumes. So this was like a week and a half ago. So it's a mixture of, relationship. It was the first time we'd met this state manager. So our BDM, this BDM, she is a champion. She's probably the best BDM we have. And part of what she was wanting to do is strengthen our relationship with this new state manager. And so the state manager got to know us, realise, our loans are quality. If we're raising something, we're not like, there is a sort of reputation of certain brokers who will just, raise issues when they've made a mistake or they haven't lodged a quality loan. So it's also about her, realising that if we don't raise an issue very often, but when we do, we do it for a reason.
Dave, speaking of behind the curtain, not only are you, when you're refinancing, you're assisting with getting the right loan product, you're also looking at the strategy behind the structure. Can you talk me through some of the questions and the approaches that you'd implement for that?
Yeah, look, I mean, it's looking at offset accounts properly. Has anything changed since the first loans were set up? If they're a new client coming to us, what issues can we find with the existing structure where they're leaving money on the table?
Mm-hmm.
Generally, for anyone who we meet with for the first time who owns more than one property, we're able to find something wrong with their structure where they could be, claiming more tax deductions or preserving future deductions, or, they've got mixed purpose debt in a loan, or, their loan structure could be simplified because they've got multiple splits for the same debt and it actually could just be combined into one loan. We can almost always find problems with people's structure when they've owned multiple properties or meeting with them for the first time. So, look, we look at all of these types of strategic elements and then work our way down from there to products, fees, offset account structure, money management approach. Yeah.
Great. Mike, let's say that the review shows that an offset account does make sense for the borrower. What do people often get wrong with offsets?
Yeah, offsets are great, but I guess like anything, they're a tool. A chef's knife might be good for chopping veggies, but maybe not so good for removing a splinter, right? So the big thing to remember, I think, is that interest is calculated daily. So every dollar sitting in that offset is working to reduce that interest charged on your loan from the day as if it was a repayment. As it was a repayment. So people go wrong when they have money sitting in another savings account, or they might have their salary going into a separate account and then they're doing some transferring it into the offset later. It might not sound like a big thing, but if the transfer doesn't happen on the same day or at the right time, or the money sits in another account all year long, you're losing some of that benefit. And that's the whole point of that offset account. And so that can really add up over the years. So the biggest thing is, if you have an offset account and you've got money sitting there, it's normally best to go into that offset than any other location.
Yeah, one example that comes up quite often is with parents who are putting money aside for their kids in an interest earning account, and that might be to cover private school fees, tertiary education, potentially to help them get into their first property. In almost all cases, the interest, they're putting that into a savings account instead of offsetting their home loan. And in almost all cases, the interest rate on the home loan is going to be higher than what you can earn on a savings account. That's pretty much guaranteed. So the interest you save by having the money in offset is always going to be greater than the interest you would have earned in that separate savings account. And a real critical point that people often forget that when they just compare the rates of the savings account versus the offset account is they're paying tax on the interest earned in the savings account. So that diminishes your returns even further. And if you take, for example, like if you had $20,000 in your offset account, let's say that's at a rate of around 6.39%, that would be saving you $1,278 across a year. Whereas if you have it in interest earning account at, say, 5%, which is a pretty good interest earning rate, and then you're paying tax in the top bracket, that sort of reduces your returns to not much above $500. So it's a reasonable sum of money that you're leaving on the table there with these little sort of problems with how you've set up your structure.
Yeah. Yeah, it's insightful. Dave, what about borrowers who like to keep their money separated into different accounts because they may not want everything sitting in one big offset account? So how can they stay organised while still getting the benefits of the offset?
Yeah, and this is where lender selection, just another area where lender selection will make a difference. Some lenders will only allow one offset account to be linked to each loan account, where there are other lenders who allow multiple offset accounts to be linked. So if you're someone who likes to separate money for different purposes and have multiple offset accounts, then this is a really important factor that should be considered when you're selecting your lender. A good example is one where parents are putting money aside for their kids, but people, often want to separate buckets for, say, their bills, and it might be like their regular bills versus maybe they want to set aside some money for tax because they have a small business, might be for holidays, school fees, their investment expenses and fund spending or an emergency fund. People have all different ways they like to sort of separate their accounts. I've actually written an ebook on money management principles, which we'll give our listeners access to through the show notes. In that book, we outline a simple account structure built around what we call the Grow Life Fun and Investment buckets, which is just a practical way to give every dollar a job, really, while still keeping your money organised. Because of instead of having money scattered across accounts that aren't helping you, you can keep your buckets separate while still having all of those balances, reducing your interest, and that's a key factor here. We often see clients aren't doing the right thing by saving money. They are often doing. Just delete that, Jamie. Clients are often doing the right thing by saving money, but the money isn't always sitting in the right place, as we've sort of provided those examples of. So part of the review is asking, are your savings working as hard as they could be? Because an offset account isn't just a feature. Used properly, it's a cash flow money management tool and an interest saving tool. But if your banking structure is set up poorly, and you've got money being routed across to non-offset accounts, you're leaving money and savings on the table, which can compound into a big sum over a long period of time.
Yeah, absolutely. Mike, what does best practice look like when it comes to using offset accounts properly, in your view? Or do you have any tips or tricks that you've used and found work for you?
Yeah, look, all the income you want to be going or directing into the offset from day one. So salary, rental income, dividends, bonuses, anything coming in. You can direct interest income into a separate investment offset. And I sort of think about that like chopping boards, like some of them have like a meat pitcher or a fish pitcher or a veggie pitcher. You don't want to be mixing them up together. The main offset, and obviously you do want to go and read Dave's ebook, he calls that the Grow account. So that's the primary lending account, because the sooner the money is in there, the sooner it's reducing the interest. The grow offset can be where all your fixed necessities are paid from. Then you can set up direct debits for the amount that you've budgeted for variable necessities, so you can track your spending, and a lot of people want to do that. And what do you call that bucket, Dave? The life account? Yep. And then you can have another offset with a weekly debit for discretionary spending, which sits in Dave's fun bucket. And geez, I'd love a look in Dave's fun bucket one day.
You've
Me
already
too,
had a few
fun
looks
bucket.
in that fun bucket, Mike,
I have my own fun bucket, mate.
over the journey.
Well, I reckon that's a wrap. We've covered a lot in this episode, and it's been great. So thank you, Dave and Mike, and Dave, to your team for providing the backbone to today's episode. There's a lot in here about how all of you at Property Planning Australia help people get the best strategy and the best structure and the right rate, obviously, to keep more dollars in their pockets and less being left on the table. We'll have another episode coming up with more practical tips on how borrowers can save money on their home loan, especially with rates rising and, in tandem with the budget changes unsettling quite a few investors, and the cost of living, continues to outpace wages. So every bit of assistance and tips that we can provide, we will. And as always, the key message is to get proper advice and make sure the strategy actually suits your situation. So don't go anywhere just yet, because we have some gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
I think compared to some of these finfluencers out there, or buyers agents talking about, having a portfolio of 1 billion properties, I have a relatively modest one, but even that becomes very, very complex, and the amount of loans can add up ridiculously quickly, and optimizing it makes a big difference, as I think we've sort of shown here today. But the focus that I wanted for my gold nugget is just the point that I made earlier. It's complex, and you don't have to pay for people like Dave, and you're not paying a premium if you're using a mortgage broker. And these people are experts, they're specialists, they do that all day, every day. I was making a joke about the credit assessors being fun at parties, but at the end of the day, it's not very dissimilar to what I do. And these people, they're out there just with absolutely sharpened skills for this sort of stuff. If you're trying to play in those leagues, you realise you're going to be doing second best for yourself.
My gold nugget is basically there's no one size fits all answer when it comes to lending. Today we've talked about a few ways many ways borrowers can reduce costs, and the things to consider when they're looking to do that. But it's also important to remember the cheapest option today will not always be the best option in the long run. So the real question is not just how do I save money this month, but the better question is what loan structure and strategy gives me the right balance of cost, flexibility, risk management, and future borrowing capacity. And that's where the strategy comes in, particularly if you have tax-deductible debt and non-deductible debt. And, this is why we focus on this broad approach at Property Planning Australia. We're not just trying to find the cheapest rate on a screen, because, that often won't be the actual cheapest rate available. And nor potentially will you even be suited to that lender or its products, or potentially not even get approved with that lender. So, there's a lot more to it than just that. So my message to the listeners is, yes, review your rate and look for savings. Do it with a quality strategic mortgage broker, but don't make decisions in isolation without considering key factors like, how can I maximize my tax deductions, and am I doing that properly? How can I build a portfolio and hold on to property? What is my repayment strategy? Why am I choosing principal and interest or interest only? And what are the pros and cons here? How can I manage risk via my mortgage, generally for most people, their largest financial commitment? How are you managing risk there? Do you have a money management system utilizing offset accounts? and what is your offset account strategy, because it actually feeds into a number of those other key strategic points that I've mentioned. So if you're not sure whether your loans are structured correctly, you're always welcome to reach out to my team, especially if you own more than one property, because we can always find holes in a structure where people are leaving money on the table.
I've got a gold nugget and it's very, very short and sharp. Dave has already said that he'll share his ebook and we'll pop it in the show notes. And just for clarity, we pop all of our EPs across the various platforms of social media. We've got an Instagram page, we've got a Facebook page, and we always put something on LinkedIn under each of our 3 names as well. But if you want to go direct to our website, it's propertytrio.com.au, and I'll make sure that it's all there embedded so that it's easy to download. It's there for you. It's been designed to help clients and listeners, so jump onto it. On that note, it's been a great episode. I look forward to seeing you fellas this time next week.
Cheers.
See you next week.
Thanks, Dave.
Look forward to it.